Hello, community, and Happy New Year to everyone. I hope that your year started filled with happiness, with joy, with confidence, and you enjoyed yourself as we're entering the new year. In 2026, community, we want to start the year right. Today is January 1st, our very first session, community session, and I'd like us to set our mind in a certain way so that we keep this session that we are about to go through today in the back of our head throughout the year, because this is going to set the stage on how we position ourselves, what we seem and deem as important, valuable, in terms of being part of an ecosystem that has strong strategies, a great track record, proven concept, mechanisms in place that literally are part of a solution, not part of a problem, that are actually benefiting the token holders of that ecosystem. And even furthermore, you're part of a ecosystem that is literally gearing itself to make the most and benefit the most throughout the year and beyond. So first of all, once more, Happy New Year to everyone. We're very thrilled to be starting this session, community event, on this beautiful first day of January. And as we move forward, may this session today set the tone for us for throughout the year as we move forward. With all of that said, I just briefly want to go through the market. We see how the market is doing right now. We're just below $3 trillion in market cap. I just want us to understand that this is a sentiment-driven industry, but as it matures, it will be more and more fundamental-driven, liquidity-driven, and strong mechanisms, ecosystem with strong mechanisms, strong strategies, strong fundamentals will be the one on top. So with that statement said, let's move forward and kickstart right away. So I came across this article, and this is something that actually exactly 2 weeks from today is going to be voted on. We're going to see whether it goes through or not. So what are we talking about? So strategy or MicroStrategy, for as it was formerly known, could be cut from MSCI index. And Saylor, the CEO, the individual we see right here on this picture, he says plans won't change. So he has a strategy in place that he doesn't want to change. He wants to stick to that plan. And what does this mean? What does it mean if strategy, the company, could be cut from the MSCI index? Let's just briefly go through this. So he is literally still defending the business model of his company known as Strategy. And he said that his Bitcoin buying company won't change course if it is dropped from the influential stock index. So before we go further, like we said, the final decision will be due January 15th. So that's when the final decision will be. Why are we discussing this? It's because it has a major impact, because Bitcoin, his Strategy is the largest Bitcoin holder with over 700,000 Bitcoin in their possession, which is roughly just below 60 billion worth in value at current prices. And if they get kicked out, they won't receive as much liquidity. And actually, there'll be an exodus of liquidity from Strategy. And this will influence or impact Bitcoin price directly. And because Bitcoin holds a lion's share in terms of market cap, and it's the largest cryptocurrency in the industry, it will affect every other cryptocurrency as well. So with that said, it's also, this is why we're mentioning this. This is the importance of this. This is why we're highlighting this. So as of now, if we look at this article, this is just a tweet that just today, right, January 1st, and based on Polymarket, and we know how accurate market usually is. So it says that the odds that Sailor strategy will be delisted from MSCI jumped all the way to 76% based on Polymarket. These are the odds, right? So like we said, this would be a huge impact, make a big impact, and not a positive one on Bitcoin and the rest of the market as well. However, one thing I also want to highlight, as funds and liquidity are moved from this from strategy, they have to be rebalanced and go somewhere. So let me explain. Usually the stock within the MSCI index, the stock with the largest market cap gets the most weighted on the index, meaning the MSCI, literally it's a liquidity pool, accumulates a pool of liquidity, and then they allocate that liquidity passively based on the sizes of based on the market cap of these stocks, of these companies that are listed on MSCI. So it's a very important index to be part of, because you actively receive liquidity. And this liquidity is actually reviewed quarterly, and it's rebalanced twice a year, meaning that stocks are added or removed from an index analysis to ensure that the index is still effective, right? Is an effective benchmark. So this MSCI is literally setting the stage, the standard, in terms of setting a benchmark for the markets that they represent. And why? What is its purpose? It's very simple. It helps and informs investors into specific industries, and it provides services such as research, data, and also certain tools for the clients to analyze and invest in different global markets. So this is why this is so important, and it holds over 80% of all indexes in the US, and it's actually it's at home. Let's see here. It has over 2,500 stocks, and it's in 47 different markets. It's a very important index that if strategy gets kicked out of it, it's going to lose a lot on liquidity. So that's the reason why it's so important, and that's what strategy is faced with right now. So the beautiful thing again about this is there's a large pool of liquidity that goes into these stocks based on their market cap. So this is why you see all these the largest stock right now is Nvidia, for example. So majority of liquidity passively goes into Nvidia, and then it trickles down to other stocks as well based on their market cap. So the aim of strategy or any other digital asset treasury firm is to become as large as possible in terms of market cap, so that they can participate in this index, so that they can receive passive liquidity as they grow. And now the challenges that I want us to look at is what strategies are sustainable. And let's look at two different strategies that are being used. One from strategy itself, which is based on Bitcoin accumulation. And the other one is SharpLink, based on Ethereum accumulation. Both are doing the same thing. However, they're using two separate assets. One is using Bitcoin. The other one is using Ethereum as their treasury asset. And they're also using different mechanisms and strategies. One is debt-based and one is free from debt, and it's actually based on compounding and accumulating actively, right? Passive income and compounding. So let's look at that. Before we look at that, let's start with strategy. Strategy is using leverage. What is leverage? Leverage is borrowed money, and they use margin. Margin literally just means that you have a capital that you're putting down to borrow even more capital, right? So you have access to borrowed capital, known as leverage. Leverage is capital that you get loaned out by a broker, a bank, whatever the case may be, so that you as a trader, it allows you to have a bigger position, right, than the capital that you actually had. So That's what it is. So based on strategy on Bitcoin, a lot goes through borrowed capital. It's not like an organically liquid asset where you see individuals are generating revenue and then using the revenue generated to purchase Bitcoin. No, you literally actively are taking on debt and diluting your stocks, selling off your stocks literally to accumulate more Bitcoin. That's the strategy. But don't take my word for it. Let's look at this specifically. So right now, strategy has always been seen as a scarcity play, right? All strategy is buying Bitcoin. That means there's less Bitcoin in the market circulating. So that's a scarcity play. So far, that was how it's been looked at. However, now as time passes, reality kicks in, and individuals are now seeing it for what it really is, and they're viewing it now as a mechanism for dilution. Why is that the case? Because two things that we need to look at, and main, it's a high octane derivative. So strategy is a derivative. We know we had a whole session about derivatives. Derivatives are, it's paper, like it's based on just paper. You trade paper. So derivatives market involves commodities, ETFs, all those are derivatives markets, which you actually don't own or hold the real commodity or asset. You're just trading IOUs, right? You're trading papers. And usually these papers are diluting the actual commodity or the actual asset because there's more of the paper trading going on than the actual amount of the commodity. So to keep it very simple, derivatives market is completely based on leverage, based on borrowed money, based on taking on more debt. That's how derivatives work. So this is why first challenge right now is, instead of looking at it as a scarcity play, it's being looked as a mechanism to dilute the stock, and it's a high octane derivative. That's how strategy is now being viewed. And first thing is because it's debt, right? It's piling up too much debt. And retail used to look at it in a good way, like, oh, they're accumulating Bitcoin. This is a good thing. And over time, Bitcoin price will just keep going up. That's a good. But now the way you look at it is different. And the way you look at it is because you see that this company is accumulating massive amount of debt. That's how you look at it. Because since institutions came in, they look at things differently. Retail is sentiment. Like we said, it's a sentiment-driven market. So while retailers are being emotional and sentiment, institutions are taking a harder look. They're like, we see how this company is massively piling up more debt, and this is not a good thing, right? And this is how the picture changes now from scarcity play to a dilution play, where you actually accumulating massive amounts of debt. How is that a business model? And if we go further, it goes even further and talks about the dilution. So it's a dilution engine, right? How is that the case? Because what you have to do, the engine of strategy is accumulation, right? To accumulate more Bitcoin. How do they accumulate? First, like we said, through debt. And now they're selling the stocks to buy Bitcoin, right? And this is how they're going about accumulating Bitcoin. So how is this a sustainable strategy? You're not only accumulating and piling up more debt, massive amounts of debt, but now you are also diluting the existing share by selling the stocks to buy Bitcoin. But it gets even more complex. Let's look at this even further. So the argument was always that strategy is doesn't have to worry about the debt because the debt is not interest bearing, meaning they don't have to pay interest on the debt. However, this cycle is completely different. Treasury now holds interest bearing obligations. They have interest bearing debts that they have to service regardless of the market conditions. So this means that historically, it's plausible based on drawdowns in markets conditions, based on bear or bull markets, there's a potential for 70 to 80% of prior price decline of this specific MicroStrategy stock. So if that happens, it would limit the company to increase, it will limit the company to get to money, get the funds to buy even more Bitcoin. Actually, it would even dilute the capital even more, because that means that they will have to sell off their stocks even more to buy the Bitcoin, since they won't get it simply by accumulating debt by the investors. So we see how this is getting ready to happen. So another thing also that I want us to understand is that the fundraising has been declining. So it's now getting more expensive to get to the money, because the tokenomics, like we said, is not attractive anymore. Investors don't want to give the money freely anymore because they saw that the tokenomics or economics is of debt-funded Bitcoin accumulation. So you have to, it's funded by debt. You keep piling up more and more debt, and now you're selling off your stocks, diluting the existing stocks, and relying on Bitcoin's price just to keep going up infinitely. That was all fine and dandy when in retailers were in play, and they were just taking all these promises that Bitcoin is going to hit millions of dollars, Bitcoin is going to be the global reserve currency, and it's going to replace the dollar, and all these promises. But obviously, that's not the case. And a strategy to pile up debt to buy even more of it is not a feasible strategy. So due to all of this, there was a lot of skeptics, and they say that this resembles a leveraged carry trade, meaning that, like we just said, leveraged carry trade means for example, when the yen still had zero interest rate, you go get yen at 0%, and then you come over and you buy assets. But and they even label it to be like a Ponzi-like mechanism, right? Because why? Because liabilities are growing faster than the operating income. Liabilities are, like we said, the obligations, the interest payment that they have to make, right? And the interest payments that they have to make are growing faster than actually the operating income. What is the operating income? The company, is it generating revenue? We'll see that when we get into Ethereum even clearer. But as of now, let's understand that the reason why there's so much skeptic in this mechanism of debt and dilution, it's because the liabilities, the interests that this company has to pay, the dividends they have to pay, and the way they're accumulating Bitcoin is based on debt, accumulating debt and diluting the stocks. And these debts and liabilities are growing way faster than the income that they're generating through their daily operations. Now that we know that, let's look at how Ethereum goes about this. So Lubin is the co-founder of Ethereum, as we know, and he made a statement during an interview on July 8th with CNBC. And it was very interesting, because he was talking about how there'll be a rising trend of Ethereum treasury adoption. And he was arguing that once individuals understand how Ethereum works and how it's literally a part of a solution and how it's addressing certain challenges that we just saw, obviously, strategy is facing these challenges, and they're taking a whole different approach. They're still stuck on the debt-driven, debt accumulation, dilution, inflation. They're still stuck on that strategy. And we all know how that ends. We see the US dollar and other fiat currencies how that they are going, right? So anyway, during this interview, Lubin said that it's about telling Ethereum story. Basically, it's about educating about Ethereum. And then he asked the question, what does Wall Street pay attention to? Wall Street doesn't pay attention to hype. They don't pay attention to sentiments and speculations, and they don't pay attention to that. What Wall Street pays attention to is being able to make money. It's as simple as that. They just want to be able to make money. They don't care about sentiments. And the way to make money is not by piling up debt and diluting your shares. How is that making money? So this is the different approach now. Let's look at the SharpLink approach. So SharpLink is what strategy is, but they are using Ethereum as their strategic treasury asset, right? So SharpLink, they received a staking reward of 518 ETH just last week. And this brings them to a total staking rewards of over 10,000 Ethereum. And this is just since end of June. So the last 6 months, they've accumulated over 10,000 Ethereum just based on staking them. They're just staking ETH and receiving Ethereum rewards. Remember how we finished this here. Let's go back here. The reason why skeptics were comparing and labeling the process as a Ponzi-like process, the process that strategy is using, was because the liabilities were growing faster than the operating income, right? So now that we know that, let's look at that. In contrast, SharpLink, they're receiving weekly staking rewards in terms of ETH, and they've accumulated over 10,000 ETH just passively. So December 30th, Ethereum's second largest decentralized autonomous treasury, also known as DAT, firm SharpLink announced that it received 518 ETH staking rewards last week. Since launching its staking strategy on June 2nd, 2025, the total staking rewards have now reached over 10,000, and its ETH holdings are currently 100% institutionally staked. So they are staking 100% of all their staking Ethereum, and they're receiving weekly staking rewards. And this is how they are accumulating their ETH. There is no debt accumulation. There is no dilution of stocks. It's a whole different concept and approach and system and mechanisms. You see the difference. Let's go even further. If you see here, SharpLink CEO says Ethereum total value locked could 10x in 2026. Now you see why he's saying it. It's because their approach is far from debt and dilution, but more of compounding slowly every week, compounding their ETH rewards, and just keep compounding it. And this is why I say that if individuals would understand how this works. Let's go back here. It's about telling the Ethereum story and what Wall Street pays attention to. They want to make money. And this is exactly what they're teaching and talking about and preaching about, is that Ethereum, you can make your passive income on a weekly basis and just keep compounding. And they, without taking on debt or diluting their shares, they're just passively earning up to so far over 10,000 Ethereum, right? And this is why he's saying that the total value lock of Ethereum in 2026 would 10x simply by just keep compounding. Just stake your ETH, keep compounding it. And this is how Ethereum is going to keep accumulating liquidity and value over time. Another thing I want us to look at is once this takes place, of course, this means that there'll be higher yield even. So Ethereum staking rewards will be even higher. There'll be liquidity, deeper liquidity, of course. And the most important thing is that there'll be also high demand based on that, right? Wherever there's deep liquidity and high yield, there's big, huge demand. And then also Ethereum also has real world asset and stablecoin demand, and that's the infrastructure where all the real world assets, tokenized assets, and stablecoins will take place. Ethereum is the trusted layer of finance. So we know that. So one thing I want us now to ask ourselves, ask the question. We saw how the approach is here. Let's look at it again. The approach here is dilution, right? It's an engine based on dilution and based on debt, right? And then we also saw here how it's looked at as some sort of a Ponzi scheme here. That's what they were talking about. And Ponzi because liabilities, debts are growing faster than what's the income is coming in, right? And we see how indeed strategy faces roughly 689 million in interest payments. It's due in 2026. So without new capital, the company cannot meet these obligations. So they have to come up with some money, with some liquidity to pay this. And where will that come from? Because they just keep piling on more debt, more debt, more debt. So where will this new money come from? They have to pay this interest in 2026. Where will the 689 million come from? And without new capital, like we say, the company cannot meet the obligations. And again, the tokenomics is based on debt-funded Bitcoin and debt-funded accumulation of Bitcoin. So now, if we look at SharpLink, I asked a simple question: does SharpLink has any debt on their balance sheet? The simple answer is no. SharpLink Gaming, the company, has consistently stated they have zero debt obligations on their balance sheet as of late 2025. They're focusing on their large Ethereum holdings and share buybacks to generate value, like we just saw. Every week they're receiving staking rewards, like we just saw. So even though they had short-term debt, they eliminated prior debt and now highlight their strong financial position with no debt. So you see the different approaches. One is strictly focusing and relying on debt accumulation and diluting the stocks. And the other one, they have a zero debt stance. Multiple reports from late 2025 confirm SharpLink has zero debt, using the phrase no debt to describe their strong financial health. So they eliminated past debt. So they used proceeds from selling businesses to eliminate interest-bearing debt they have zero interest-bearing debt. They have no recurring debt that they have to service. So their focus is on Ethereum treasury. Their strategy involves holding significant amounts of Ethereum and using it to generate income through just by staking 100% of them, right? Making the balance sheet robust without needing debt. They don't need debt. You see the different approaches that are being taken. And you can only do this with Ethereum because Ethereum literally is an active asset. And at the same time, it's also a technology that as it's being adopted, it's being used specifically for stablecoins, real-world assets, and tokenization of markets, financial markets. That's how its value comes from. The more adopted it gets, the more liquid it becomes, the more higher yields it gives, the more demand for Ethereum gets here, and so on and so forth. So in summary, the current narrative of SharpLink Gaming is that they are debt-free and leveraging their crypto assets to receive passive income, whereby the other Bitcoin strategy is strictly based on leveraged borrowed money, piling up debt, and diluting the shares. So the question here is up to you. Which strategy is building for the long-term success? This is something that I'd like to give us as a community and individually as a collective. Let's ask ourselves and let's answer this question to ourselves. Which system, which mechanism, which strategy do you think is built in a sustainable manner for the future hundreds and hundreds of years to come, and it's going to be sustainable. Is it the one built based on debt accumulation, speculation, and dilution of assets? Or do you think it's one that is literally debt-free and keeps compounding its staking rewards over time on a weekly basis? I'll leave you to answer that. And I want us to close out with this. This is exactly the reason why we focused so much on strong fundamentals with the bull run ecosystem. We have a staking platform known as the bull run ecosystem. And this is exactly what this staking platform does. It burns its supply, not from circulation, but from the total supply. In addition, it accumulates liquidity as well, so that those who are trading it, as there's buys and sell going on, the trades are happening, it's also accumulating liquidity to facilitate the individuals that want to unstake and sell off their bull run tokens so that they have enough liquidity. So it's a staking platform that retains liquidity in order for those who want to exit their staking position, they'll have enough liquidity to do so. At the same time, the token you are staking, BRL in this instance, it's scarce, literally. So it's not just a scarce play talking about, oh, it's a scarce mechanism, but it literally does. We started with 1 million in total supply. Now we are down to 959. So we burned over 40,000 BRL tokens that we'll never see again. They're removed from the total supply. And then another aspect is that to avoid sell pressure, the staking rewards are not in BRL tokens, but are in USDC distributions. So meaning that as you're receiving your USDC distributions as your staking rewards, you can use that in real life to cover your expenses, or you can buy back and add more BRL token to your wallet. And this is exactly how we set up these mechanisms, this strategy, this ecosystem, in order to be sustainable beyond tomorrow. It's built for the long term, and it's built to be sustainable and to grow over time. The more it's used, the more valuable it becomes, the more liquid it becomes, the more USDC distribution, staking rewards it gives without causing inflation. And all of that is done, and it takes advantage of the volume facilitated by the liquidity that it's accumulating, that it's retaining, to keep burning the supply, to keep retaining liquidity, and to keep increasing its staking rewards without causing inflation. These are the type of ecosystems you want to be part of. Again, this is not financial advice. Like we just looked at two separate strategies. Strategy based on Bitcoin, debt, dilution of stocks. Sharplink based on zero debt, stake 100% of your Ethereum and receive Ethereum rewards in a weekly basis, keep compounding and piling up. And bull run ecosystem is adding burning scarcity, is adding liquidity retention, and gives out not native token, but USDC in order to actually encourage buy pressure for bull run. And with every trade, the supply keeps shrinking, making it more valuable. Liquidity keeps increasing, making it more attractive for traders. And due to the trades, it accumulates sustainable staking rewards that is pushing buy pressure, putting in buy pressure for the stakers, meaning they can add more bull run into their staking bags. So with that said, this is a message for today. The first day of January 2026, the message is let's focus and be part of ecosystems, mechanisms, strategies that are built for the long run and that we know that are going to be sustainable. They're going to be around for 1,000 years to come. Not based on hype and speculation and wishful thinking, but based on fundamentals, sound strategies, great mechanisms that are obvious, that are proven, that have a track record, and that have a proof of concept, like the one we have right here in Ethereum, and also like the staking platform that we have here in the Bull Run ecosystem. That's the message for today, community. Let's keep this in mind throughout 2026 and beyond, in the back of our heads, that let's focus on mechanisms, on strategies, on ecosystems, on tokens with strong fundamentals, tokens that are part of a solution, tokens that are addressing challenges. Let's be part of a solution, not part of a problem. Let's add value to this industry, not add even more challenges and more problems. We need to move away from the mindset of speculation and sentiments and go into the mindset of strong fundamentals and looking for ecosystems and tokens that are addressing the challenges, which is inflation. Ban them, which is lack of liquidity. Retain them, which is causing inflation as you give yield distributions. Like we saw is in the case with strategy. Address that by ensuring that your staking distributions don't cause inflation. Don't dilute the existing staked tokens in the industry. That's it for today. I hope it was of great value, and I appreciate you all, community, for participating in today's community event. And I also want to ensure that you have a great start in the year, in this year 2026. And I'm grateful that we were all able to start 2026, kickstart it on the very first day together as a community. And I also want to encourage us that tomorrow, Friday, and ensure that you are part of the session that will take place tomorrow as well for the Queens. And I appreciate you all again. Let's ensure that we engage with the tweets that are all out today based on our community events that we always participate in. It's to bring awareness to our industry and to our ecosystem as well. With that said, community, I want to wish you all a wonderful, wonderful rest of your day, a beautiful start in the year, until we'll meet again, community. Bye-bye, everyone.